Wow, what a week it was last week. We saw the S&P 500 have a little bit of volatility. I'm going to be talking about volatility a little bit later on and perhaps why we might be getting more volatility coming up. We saw the S&P 500 suffer some down days, particularly on Friday. It was a busy week last week. We saw some strong earnings come out from Microsoft. Well, I think Microsoft was the winner of the big ones. Amazon came out, beat expectations, but investors did not like the fact that the AWS had lower than expected gross margins, and Amazon also came out and said that they were concerned about buyer behavior in the future. So investors did not like that. Overall, we've seen earnings come in better than expected. The companies that aren't meeting expectations, though, are getting hit really hard. So yeah, it was a busy week for earnings, but also economic reports. Very busy week last week. On Tuesday, we saw this kick off with the JOLTS report coming out. We saw the job openings coming at 4.37 million versus the 7.51 expected. So fewer jobs openings, which is not a good thing. And then on Wednesday, we saw the PCI price index came in at 2.6%. Which is higher than expected at 2.5%. So we had higher than expected inflation, also not a good thing. In addition, on Wednesday, we saw GDP come out, and on a quarter-over-quarter basis, it came in at 3%. That's a very solid number compared to the expected 2.5%. Now, that was a bounce off of the previous quarter, which was a report which is negative 0.5%. But this 3% here growth is maybe not as strong as what it looks like on the headline number. If we take a look at the GDP and we take a look at consumption and investment, just those two factors here, we can see that those two factors have been going down. They came in last quarter at 1.2%, which is actually quite weak relative to what we've seen over the last number of quarters here. So that is a fairly substantial decline. That's important because if we take a look at the GDP here, GDP, according to First Year College University, is made up of consumption, investment, government spending, plus export minus import. So these two key components here, C plus I, which are the most important components, were weaker than expected. And so what we saw was perhaps government spending making up for that. This is hard with all the tariff situation and trying to figure out what's going on there. But government spending really is not a key driver over the long term for solid continual growth for an economy. It's these two figures you want to be taking a look at, and they were not good. On Wednesday, we also saw the Federal Reserve come in with its interest rate decision. It held at 4.25 to 4.5% for its federal funds rate. Here it's been holding on for quite a while. Powell was criticized by Trump and a lot of others as well, a lot of economic analysts. He's being roundly criticized by quite a few people in the press, analysts, etc. And what we've seen here is we also saw two Fed governors, Waller and Bowman, a dissent in favor of a rate cut. This is the first double dissent since 1993. So we're starting to see some of the Fed governors start to say, well, no, maybe we should be cutting at this point. Of course, it's possible that we could see these governors going for Powell's job. They're trying to sell themselves to Trump, particularly Waller here. On Friday, we saw the non-farm payroll number come out, and it came in weaker than expected. It came in at 73,000 versus an expected 106,000. So quite a weak jobs report. The key thing here, though, is look at May. It was revised down by 125,000, and June was revised down by 133,000. That was a disaster. Here's an interesting graph. This is looking at considering the labor force participation rate since April. And if you take a look, here is what the report came at 4.2% for unemployment. This is the unemployment rate. And it's being suggested that perhaps the unemployment rate could have been 4.9% if it wasn't for the collapsing labor force participation rate. So you're considered unemployed if you're willing and able to look for work, and you've within a year. Once you fall off, once you get past that year, if you haven't been working, you're no longer considered unemployed. You just fall off the map. And if that number starts to increase and people are not taking on jobs because they just don't want to, then you have this labor force participation rate decline here. And it's interesting that perhaps the unemployment rate could have been higher, maybe not as high as 4.9% as suggested, but nevertheless, the labor participation rate was down substantially, which would make the unemployment rate look lower than it really is. The employment situation also might not be as good if you consider what the household survey has been putting out here. So the household survey is done by the BLS, the same institution that does the non-farm payroll numbers, just a different survey calculated differently. In July, they were saying there was a loss of 333,000 jobs. That's a huge loss. So how could that be? How could one institution be putting out two different surveys with really different results? And the big factor here is that the way they calculate full-time jobs, or jobs basically. So the establishment survey, the non-farm payroll number, says, well, if one person loses their full-time job, gets a job at Uber plus another part-time job, that actually counts as 2 jobs. So we have a net increase for society of 1 job. So it looks like jobs are going up. The household survey says, no. We're only going to take a look at one person being able to have 1 job. And that's the way they actually calculate it. And this makes sense in the sense that in today's society, we find a lot of people are actually participating in the gig economy. They may lose their job and go off and work in the gig economy and say, well, I'm going to go work for Uber or whatever it is. So things are a little bit different than they used to be. And that might be a better way to consider them with the household survey. So one person, if they've got 3 part-time jobs at McDonald's and Uber, etc., that's only considered to be 1 job. And if you take a look at the way this is measured here over the 3-month average, it's down 287,667. That's a huge downtick for this number, the worst reading since 2020. So it's hard to say that the employment situation is really strong in the economy. I know Powell's been saying that, but it's getting hard here at this point. The impact from the weaker than expected non-farm payroll number had an impact on Treasury, positive impact on Treasuries as yields headed lower. And here's the 2-year yield. We saw the biggest daily drop since early 2024. After the non-farm payroll number, we saw the expectations, probability that the Federal Reserve will cut its federal funds rate in September jump. It jumped to over 80%. It was before the meeting, it was at 49%. That's a huge jump. And now we're finding more investors are expecting the Federal Reserve to start cutting its rate in September. On Friday, August the 1st, it was the day that Trump was going to assign tariff rates on countries that hadn't been able to make a deal with the U.S., and Trump instituted a 25% tariff rate on India. This is a quick chart showing the U.S. tariff rates on Canada before the tariff debacle and where we stand currently here. We can see softwood lumber has increased to 27.3%. Steel and aluminum, 50%. Cars and trucks, 25%. Copper, 50%. Here's the biggie. Other goods, 35%. This was supposed to be 25% on August the 1st, and it was bumped to 35%. I'm not going to get into the politics of why that could have happened between Canada and the U.S. here, but overall, this is not a good situation for Canada at this time. For more drama on Friday, we had Kugler resign. She's the part of the federal. She's the federal governor on the FOMC. I'm not going to get into why she resigned. She didn't really say. I'm not going to speculate. But it does leave Trump with a vacancy to fill. This is going to be an interesting situation. On top of that, on Friday, we did see Trump come out and say he was going to fire the head of the BLS because he did not like the June number, or the July number, I should say, for the employment situation. And I do just as a reference here, put out this post here by Trump. In this case here, this was back in June. Okay, so this would be for the May numbers here, and he really liked those numbers as from there. So from one month to the next, and now I want to say that I have been a critic of the BLS for quite some time. And if you go back and look at past videos, newsletters, for a long time, because they've been off. They've been consistently off. Their algorithms just aren't working in today's market. I don't think there's anything nefarious going on. I don't think they're trying to do anything with, it's not a political situation so much. I just think their algorithm is not a good algorithm for what's going on. Now, here they're reporting on August the 1st for July. So you know these are not real numbers. They're guessing at these. So you've got algorithms that guess. Basically, there's something called a birth-death model for small businesses, which has just been just absolutely terrible. They've just been really, really kind of crazy on this. So, I think that perhaps there needs to be an examination of what's being calculated and how they're calculating the numbers overall. But I don't think there's any ill intent here where we stand right now. But anyhow, once again, a little bit of drama taking place. Okay, if we take a look at the price action last week for the S&P 500, it was mostly a down week the last 4 days, and here was a big down day on Friday. If we look at the major sectors for the S&P 500 here, we can see that, well, first of all, the S&P 500 was down 2.4%. The material sector was down over 6%. So we saw a lot of the cyclicals get hit hard last week. Industrials, which has been a performer, was down more than the market overall. And here we can see the utility sector was the only positive major GIC sector here, 1.5%. That benefited from falling interest rates and a risk-off move in the markets. Here's some other sectors in the market here. Gold was nominally up. Here's the gold miners down 2.8%. That's largely to do with a risk-off move in the markets. We could actually see this gap actually close next week here. If we take a look at some of the other sectors, metals and mining, once again, a cyclical sector down a lot. Steel, 7.5% negative. Transportation was actually off quite a bit. Here's uranium. Here's an interesting one. Uranium had 12 positive weeks in a row, just absolutely doing incredibly well. One of the weeks up 9.2%, really strong. Lots of announcements. Nothing negative about this industry here at all, and it did extremely well. But we did see that pullback when we saw the market pull back here with some of the cyclicals here. Now, I do want to say that uranium sector has a strong seasonal period starting in probably about 9 weeks or so. So we could start to see an opportunity build for the uranium sector coming up shortly. This graph is of the U.S. 2-year yield. Here you can see it's been trading in this downward channel here. And touching on the point here, touching on a point again, touching on a point here again. And last week it touched on this point. This red bar represents Friday, and we saw that down day. From a technical perspective, we would probably expect it to continue in this downward channel here at this rate here, particularly since we're in the strong seasonal period for U.S. government bonds. This week is a busy week for earnings, not as busy as it was last week. We're starting to see earnings season wind down, but still, nevertheless, there are some key companies reporting Monday after the bell. We got Palantir, Tuesday after the bell, AMD, Wednesday before the bell, Uber, Shopify, McDonald's. So some companies to look at. We'll have to see how the market reacts. Overall, earnings have been fairly good for companies so far in this earnings season. Companies not meeting their expectations have been getting hit hard. So we'll have to see how the market reacts to some of these earnings this week. Okay, I just want to take a quick look at volatility because I think it's really key here at this point. I want to reference my Thackeray's 2024 Investors Guide here, and this is a page from my book, and what you see is volatility tends to pick up from July 3rd to October the 9th, but it's mainly mid-July, late July, you start to see that increase, and that happens into October. You tend to see a volatility pick up. Here I've got some basic stats on how volatility has picked up in this time period. From 1990, we see the average for the VIX implied rate to 2022 has been just under 20 in the marketplace, but this is the time period where we can see it start to move higher, and this is going to be something to watch out for us. So let's see where we stand right now. So here we are here just under 20, so just under the average, and here's that spike we saw last week as well. But before that, we did see a downward trend. We're not down to the same levels, low levels that we did see in 2024, but we're still below this average level of 20. If we take a look at that time frame where volatility tends to pick up from July, or early July to early October, here you can see in 2024 that did take place. And in 2023, we did see volatility pick up once again and then head lower. In 2022, the same phenomenon happened, and it's important to note that volatility tends to peak in either late September, sometimes a little bit earlier, mid-September. So not only does it bottom around this time of the year, but it tends to actually peak in September or October as well. If we go back into 2021, we see here from early July into October, the same thing, we saw volatility pick up once again. I want to show this graph to focus on market breadth, because market breadth is not good at this time. It doesn't mean the market's going to go down. It just means the market's becoming more and more susceptible to correction because we're having fewer stocks drive this market higher. There's a lot of different ways to look at market breadth. And I'm just going to show you a couple here. Here's the S&P 500 in white. This gold line is a 200-day moving average. This blue shaded line, if you want to call it that, is the number of stocks, percentage of stocks above the 200-day moving average. And as the S&P 5 moves higher, you want to see more and more stocks participating in that run. So you'd see a higher number of stocks trading above their 200-day moving average. But if you take a look here, we can see here that at this level here, back in 2024, we're still well below that level. From here to here, we've seen the market have a really strong run, but it's been a very few stocks that are really driving that much higher. It's not a lot of stocks that are pushing the S&P 500 higher. Here's another way to take a look at market breadth. Here we're using the S&P 500 equal weight ETF RSP. So how that differs from the S&P 500, the S&P 500 is a capitalization weight. What that means is companies like Apple have a much bigger effect on moving the price of the S&P 500 than a much smaller company in the S&P 500. In the equal weight, they're all given the same weight and they all push the price of the S&P 500 equally. So it's a much broader index. And if we take a look here, the RSP has been moving higher. So the S&P 500 equal weight has been moving higher. But take a look here, close to the top here. We've seen this price movement where it has been heading higher. But look, if we come down to RSI, what we see the RSI heading lower. This is called a price divergence, where you've got the price moving higher and you've got the RSI moving lower. It doesn't mean that the S&P 500, in this case the RSP, is going to head lower, but it does set up for that condition. This is a graph of post-election cycle. So this is the year after the election in the US compared to where we are in 2025. Here we can see that we tend to see around this time of the year the S&P 500 peak in post-election cycles and then head into put in a bottom sometime in September, October. Here's where we are right now. It doesn't mean that we're going to see this happen, head lower here. We have seen this year a little bit of a following trend on that, but it is something to watch out for. Well, we are in the weaker period for the market from August to September, but at the same time, the market's being pushed by the retail sector. If we take a look at this graph from Bank of America, this shows the net buyers in the market here. So we got corporate and retail investors actually being huge net buyers, and we got institutions being net sellers. So this market's really being driven by the retail investor. And when that happens, we can see the market continue to go up in a parabolic move. Now, the caution on that is that, in that type of environment, when you see the retail sector really push things up in a speculative manner, we can see the market, when it does crack, it can crack fairly quickly and very sharply at the same time. Given that we are in this weaker time period for the market from August to September, this is the time when the bigger drops in the market happen. So I can't say that that's going to happen. I can't say it's going to happen next week or 2 weeks out. But the market is susceptible to that, given the overall conditions of being in a weak seasonal period and it being pushed higher by the retail sector. It's going to be an interesting week this week coming up. Thank you for joining me today, and please don't forget to like the video and subscribe. Thank you.